Hello, everybody. Good morning. We're just starting the week now. Okay, second week of the trading year. London's been over about an hour, and risk sentiment is definitively softer, as you can see here on the right-hand side. Okay, so all of these sort of risk barometers that I've got here, a lot of red on the screen there. Dollar's obviously heading higher as well. Usually a pretty indicative, but it's not really sort of a drastic sell-off. It's just pretty. What's the word? Just pretty negative start, to be honest, to the week. So obviously we started here. We've got the dollar index. We're starting to see a bit of strength in the dollar, which is obviously filtering through to other assets as well. I wanted to take a look at gold really to start things off. I think gold's really interesting in the current context. We've, from a technical perspective, as you can see here, we've been ever since this kind of this peak back here in August. Okay, just up at what were we at? $2,068. We've sort of been just gradually in this sort of descending channel here, okay, flagging back down into these sort of previous areas of resistance, which now become support. And after this big sell-off on Friday, we've seen, obviously, again, buyers are stepping in, trying to push us back above, back into the sort of middle of this channel and beyond, and maybe get a breakout above highs at some point in the future. I very much doubt that'll come this week. Really what we're seeing here, rather than just being indicative of the dollar, risk sentiment overall or anything else, or even just technicals, is more focus on inflation expectations and this US 10-year Treasury yield. So what I've done for you here on this window, I've inverted the gold chart. So you can see obviously lower prices as we head up the scale here. Okay, and that goes with rising Treasury yields. Okay, so what we would expect to see most of the time is that as the Treasury yield increases, gold will sell off. Okay, that's part of the picture, because obviously gold is a zero yield asset. Okay, treasuries, at least, it's not much to get excited about, but they get you 1.10%. But also what we need to do is factor in inflation expectations to get the real yield. Okay, so what we'll do is we'll go over to the Fed here, St. Louis Fed, and we'll use their data. We've got the 10-year treasury rate, obviously on the close, 1.08. And the 10-year break-even inflation rate. So what we're seeing is inflation expectations obviously headed higher ever since this sort of trough, this bottom back here, in the sort of height of the COVID crisis back in mid-March. And ever since then, obviously, inflation expectations have been increasing. And what this gives us is, if we take the Treasury yield at, okay, so we'll call it 1.10%, and we take away inflation expectations, what you get then is obviously your inflation-adjusted returns, or the real rate, which is currently minus 1.01 to be precise. Obviously, as that rate before has obviously been more negative, and that has, as expectations for inflation have been low, then obviously gold is more appealing as a zero-yielding asset because it's more positive than the negative-yielding assets once you adjusted for inflation. As we're now seeing inflation expectations increase, we have to be aware of that impact that has on gold, and the potential for it to really push lower if we see the Treasury yield increase, and also if we don't see inflation expectations increase, then US Treasuries will look a lot more appealing, because obviously if inflation expectations reduce, then we're narrowing that gap and heading towards the zero level once we've adjusted for inflation. And obviously, potentially, those will increase in value as well. All right, so that's gold covered there. We've also got the US CPI reading for December this week, which is going to feed into this. So obviously, that's at 1 p.m. on Wednesday. Inflation expected to rise by 0.4% month on month, 1.3% year on year. And really, that's going to be a good indicator of how forward-looking the market can be with inflation. If there's a soft print, then obviously that's going to really give us a view on that. Since yields have been rising for a while now, we really want to see if what the strength of belief is in this kind of rising inflation narrative, and whether or not yields can keep on rising on the back of that. Okay, so that sort of really covers what I wanted to talk about there with the dollar and gold. There's one particular chart that I really like the look of this week, which is pound yen. Okay, so if we just take a look at this here, this is on the daily time frame. I'll just zoom out. There we go. Right now, I really like this area here. Okay, so this is sort of a flip zone, as you can see. It's been resistance over here, support. Okay, we tried to get back above it over here. We fell away, but ever since we bottomed down here, we've been pushing up higher, and we look like we're going to have another crack at breaking this level. So really what we want to see for this is some positive risk sentiment, okay, coming back into the market. I don't know whether we're going to see that immediately today, but at some point through the week we may well do. It's pretty much on a whim at the moment, it seems, how risk sentiment can flip sort of slightly negatively with not really much driving it. Obviously, we're sort of in chaos around the world with lockdowns and everything else, but the market's looked beyond that, as we mentioned in the video last week. So yes, so we really want to see the pound break out above this level in the yen. Okay, we want to see it up here. 141.377 is the area that I've got marked, and then push on up above this high here. And then obviously just target this area here up to these highs and beyond. I think the narrative of the UK being sort of down and out after Brexit was well overdone. And we're seeing this sort of recent strength in the pound has really highlighted that. So that's the main chart that I'm going to be watching. Right, and just taking a look at the calendar here towards the end of the week as well. On Thursday, we've also got Biden announcing his sort of stimulus and relief plans, which will have an impact on overall risk sentiment. Remains to be seen sort of how much will actually get passed, but the objective will be very much in focus, and the headline number as well. Probably going to announce something, looking at sort of multiple trillions. But in reality, we'll probably get significantly less than that by the time it's all gone through the political process. Okay, also got US import and export prices, and the jobless claims here will be in focus. So you can see the continuing and initial claims here. As we saw a soft NFP reading at the end of last week, Fed Chair Powell will also give his thoughts on recent events in the markets, I'm sure. And we'll see where yields are when we come into that too. OPEC monthly report shouldn't really tell us anything significant after the move by the Saudis at the last meeting to cut output and keep oil prices supported. And then on Friday, really, it's going to be a tough day. You've got obviously harmonised inflation rates, lots of UK data here. Much of it's sort of backward looking, but it still gives an overall sort of look at how the economy is doing since we moved into the second stage of restrictions. US retail sales as well. I mean, there's, and the core PPI, there's a lot going on Friday. It's going to be a tricky day. And we're also seeing earnings from the earnings season starting up again. Basically, we've got the banks, as always, leading the way. JP Morgan, Wells Fargo, Citigroup, probably the highlights of those on Friday too. So have a great trading week, guys, and I'll catch up again soon.